Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on market events. Let's get started. Unfortunately, this is another somber and rather sad Market Insights, because the predictions we made in our last video have tragically come true. Russia has indeed invaded. The Ukrainian people, after 100 years of experience of Russian abuse, are resisting ferociously and really inspiring freedom-loving people everywhere around the world. And also, as we discussed as a possibility, Russia is repeating its Syrian and Chechenian playbook, which involves extensive shelling and bombing of civilian areas and trying to burden the resistance fighters with caring for wounded and starving civilians. It is shaping up to be a horrible, terrible, tragic event for the people of Ukraine. How will it end? Who knows? As we discussed, history says that a determined resistance by a people, as long as they can be supported by friendly nations, history shows that each and every time that resistance has always won through. Whether you're talking about the United States and the USSR in Afghanistan, whether you're talking about Great Britain in Ireland, Napoleon in Spain, the Spanish in Portugal and in the Netherlands. I mean, go all the way back in time, and no matter how overwhelming the military power, a determined resistance always wins if it can be supported by friendly nations. And that's the big if, is whether or not certainly there is an intent and a hope that NATO allies will continue to provide overwhelming support for the Ukrainian resistance, but as the Russian juggernaut continues, who knows whether they will be able to continue to have access to some of the major cities and so forth and provide that support. We will just have to see. In the meantime, at Caravel, we have Ukrainian friends, we have professional relationships. They are in our prayers. Each day we come in hoping to hear from them and hoping that their family is safe and that someday they can go back to a normal existence. Until then, we have to deal with the prosaic and yet important implications for our lives and our portfolios. So far, markets in the United States, the S&P is down about 10% year to date. And most of that happened in January before the invasion occurred. So US markets are behaving pretty well. Now 10% may sound scary, it's a typical definition of a correction, but to put that number in perspective, it means that the S&P 500 is back to where it was in October. That's not the worst thing in the world. Now, on the other hand, commodity markets have been on fire. Oil is up 45%, wheat is up 50%, gold is up 7%. And we're going to talk a good bit more about those commodity markets and what they might mean. In the meantime, this invasion has, the Federal Reserve it had some tough decisions to make before oil jumped 45% and wheat jumped 50%. Now those decisions become even tougher. As people have been watching our videos know, we have been of the opinion from March of 2020 that the Fed printing as much money as they were printing was going to turn into inflation. And lo and behold, that inflation has occurred. But this is geopolitically driven inflation. And importantly, the Fed has committed to shutting down its printing press. It's not going to print any more money after about March. So this is a critical moment because in addition to shutting down their printing press, if you were to go back before this invasion, before all this occurred, the market was pretty convinced that we were going to get a 50 basis point increase in interest rates in the March meeting, and there'd be a steady drumbeat of interest rate increases and maybe even unprinting money, draining money from financial markets to accompany those interest rate increases. Well, this geopolitical instability has changed some of that calculation. Fed Chairman Powell announced this week that he personally is going to vote for a 25 basis point increase, and that the Fed is looking to be more cautious in pulling back on stimulus than they might have been before. And you may ask yourself, why would that be? Oil prices are up, wheat's up, inflation's going to be terrible. Well, there's kind of two types of inflation, and the Fed doesn't know which type we've got yet. And what I mean by that is okay, oil has hit $108 a barrel. It's up 45% year to date. It's almost tripled from its lows. It's more than tripled from its lows. It's tripled since early 2021. All right, that is, let's think about the 70s. You know, oil prices are up, and that led to an inflationary cycle. But importantly, throughout the 70s, as oil prices were going up, until Paul Volcker came into the Fed in 1979, as oil prices went up, the Fed printed more money. As you know, so the increase in oil prices was monetized by the Federal Reserve. The Federal Reserve is now saying, we're not printing any more money. I know we printed a ton in the last 2 years, but we're not printing any more. So that means it's going to be different from the 70s. There's a whole lot that's printed, there's a whole lot that's in the market, but they're not going to continue printing as oil prices rise. So it is possible that unlike the 70s, this could be like 2015. 2015 was the last time that oil prices were at 108, 110. And at that point, the Fed was not printing money. They had printed a ton after the global financial crisis of 2008, and then they did QE1, 2, QE infinity. Yeah, so they had printed a ton of money, but they were not printing anymore. In 2014, 2015, as oil prices went way up, instead of setting off an inflationary cycle, those higher oil prices drained money from consumers' pocketbooks. As we all know, as we sit and fill up our cars right now today, oil at these prices is a huge hit to the spending power of consumers. So, is this event going to be like the 70s? Or is it going to be like 2014, 2015, where the oil increases essentially became a brick wall that the economy hit? It didn't become inflationary, it slowed down the economy. Yeah, it's tough, and I don't think the Fed knows. And I think that's exactly why Powell said, we're going to do something because the inflation has been scary and it worries us, but we're not going to be dramatic. We're not going to be bold. And that means that, that's supportive of stocks compared to a bold Fed that's draining liquidity from financial markets and raising interest rates dramatically. But it's also, if they get further behind the curve of inflation, it could be long-term problematic. This is something we're just going to have to watch. We don't know any more than the Federal Reserve whether this is a 2014-15 kind of event where consumer pocketbooks are being drained, or it's a 70s kind of event where it's starting off an inflationary spiral. Probably the big driver will be, do wages continue to grow at a super fast pace? If that happens, then we may be leaning more towards the 70s. But stay tuned. We're going to keep watching this. All right. Now, what about, let's step outside the Fed. Let's step outside the equities. Let's talk about oil. It is dramatically increased since it became clear that Putin could be invading Ukraine, and the market started worrying about it in January, got really worried about it in February, and then of course it occurred. So why is that creating such an upward pressure on oil? Well, it's pretty simple. The US is the #1 oil producer in the world. We make about 12 million barrels per day. But #2 is Russia or Saudi Arabia. They kind of swap back and forth between #2 and #3. They make about 10.5 to 11 million barrels per day, and who's #2 or 3 swaps back and forth. It's not really that important. The point is Russia's super, super important to energy markets. They are a huge supplier of both oil and natural gas, and they're the dominant supplier in Europe. Now you may say, well, wait a minute, I've been reading that the sanctions that the EU and the Biden administration and Japan and almost everyone around the world has imposed on Russia, they were designed to avoid the energy markets so that this would not have happened. And that is true in theory, but in practice, there's a problem. And that is that while the sanctions have avoided the energy market, the participants in the market, the banks, the energy traders, the energy companies, they're all looking at this dramatic, ugly violence that's happening in Ukraine, and they are wondering, can we afford from a public relations perspective to do business with Russia? And if you say, well, wait a minute, oil companies have been doing business with really horrible regimes for 120 years since they invented oil companies. Why would they care now? And maybe they don't. Maybe what they're really worried about is that Russia in 1998 defaulted on all of their debt. And when people say, wait a minute, we've got a loan agreement, we've got a deal, Russia basically said, and we've got nuclear weapons, so go pound sand. And then a little bit later, Putin comes into office and he looks around and he looks at the oil assets that are owned by American companies and European companies and so forth. He said, you don't own that anymore. I'm stealing this from you and I'm going to give it to my friends who are going to help me solidify power, and they're going to give me kickbacks that is going to allow me to buy a 300-foot yacht, right? So what that means is there's no rule of law in Russia. Your contract is what Vladimir Putin says it is. And if he wants to tear it up, he will. And so he's not in a good mood right now. So how comfortable would you feel doing a deal with a Russian company? Even though it's not prohibited by the sanctions, are you maybe worried that you get screwed by Vladimir Putin? And how bad do you look? How obvious is it that that was a stupid thing to do? So even though legally and technically companies can still do business in energy in Russia, they're practically not doing it. Most companies have stepped away from any transactions in energy. And that's, as the market kind of digested that this week, that's why you saw another $10, $12, $14 surge in oil, as people were like saying, it doesn't matter what the sanctions say, the impact of the sanctions and distrust of Vladimir Putin effectively means Russia is falling out of the energy market. And that means higher prices for longer. All right, so what do we do? Well, in the US, you would hope that American producers would look at these prices and really get to pumping some oil. And that's happening. We've gone from, in the beginning of 2021, we're making about 10.5 million barrels per day. We're now at 12 million. That's great. But we could be pushing 13 million. And we could be pushing, that would be our all-time high production pre-COVID. We could, push beyond that all-time high. Maybe we could be at 14 or 15 million. Why aren't we getting there sooner? Well, it's not because of what you hear on a lot of the news media. It has nothing to do with the Keystone Pipeline. The Keystone Pipeline was going to bring Canadian oil into the US market to compete with American oil producers. And for one, it wouldn't have been complete until 2030, so it has nothing to do with what's going on right now. But it also, by getting rid of it, long term, that gets rid of a competitor for US oil producers. They should be really excited now about producing oil, but they're not. Why not? Well, because in 2020, when the global economy shut down, the global economy basically gave up economic growth for Lent in 2020. And that meant that no planes were flying, no cars were traveling, no one wanted oil. Oil prices actually went negative, which meant oil producers had to pay people to take oil off their hands. And then even after they came up from negative, they stayed at zero for over 2 months. And they were at depressed, unbelievable historic lows for almost all of 2020. So that means that US fracking producers lost oceans of money in 2020. And what they came into 2021 and 2022 determined to do is, I don't care where oil prices go, we are going to recoup those losses before we invest a huge amount of money in new production. And that determination is reinforced by the fact that, you know, the number 2, number 3 producer, Saudi Arabia, you would think they'd be pumping oil right now too, but they're not. And you can say, well, President Biden isn't there. There isn't any Keystone in Saudi Arabia. Why aren't they producing oil? And the answer is in 2014, oil got to $110 a barrel, maybe $115 a barrel. It got there because Saudi Arabia and Russia were manipulating the oil market, holding production off the market to get prices higher. And US fracking producers were like, this is fantastic. We're going to invest in more production. Our oil production was soaring. We went from 6 million barrels per day in 2008 to 10 to 11 million barrels per day by 2014. Unbelievable, spectacular growth because of the fracking revolution. But the Saudis and the Russians looked around and said, oh my God, we're creating a monster. We're creating a competitor in these frackers in Texas and Oklahoma and South Dakota. And so we're going to crush them. And they sucked in the frackers with huge investments in 2014 with high oil. And then suddenly the Russians and the Saudis opened the floodgates and dumped oil on the market and took prices down to 28 bucks a barrel. And lots of frackers lost their shirt, went out of business, right? So the history of fracking is it's changed the world because the US went from like 5th or 6th biggest oil producer to number 1. But none of the players in fracking have made any money because of these periodic disasters like 2015, 2020. So they are determined to make that money back before they get too aggressive. And when they see Saudi Arabia still not pumping oil, despite oil at $100 a barrel, their mind goes back to Russia and Saudi Arabia manipulating the market and the way they got suckered and the way they lost money before. And it's making them twice bitten and thrice shy about getting too aggressive about new oil investments. So if you were to ask me, there's a couple of policy responses that should happen and may happen, because quite frankly, the midterm, if oil is still at $110 a barrel and Biden hadn't done anything about it other than dumping a little bit out of our strategic petroleum reserve, then it's going to be a disastrous midterm election. If I were the Biden administration, I would say right now, today, this is an energy emergency. And we are going to declare that no oil company can do dividend increases or stock buybacks until oil production is at 14 million barrels a day or 15 million barrels a day, or Russians are out of Ukraine. Until that happens, we have a state of emergency in the energy markets, and the US government needs to react to it. And I think we also need to recognize that we have a similar state of emergency in food markets. Grocery prices are already really straining a lot of people's pocketbooks, and that's before wheat jumped 50%, because Ukraine is essentially the Kansas, Nebraska, Iowa of Europe. And there's not going to be any spring crop in Ukraine because you can't plant wheat in a battlefield. And so you're going to lose this huge producer. And I think we ought to have a response from the United States. We're the #1 wheat producer, corn producer. We are the breadbasket of the world. We pay farmers not to grow crops. It's our subsidy program. This is a year we should say, you'll still get your subsidy check, but you plant as much as you want because we need the food. We will keep an eye out. We will see if there are more bold and dramatic policy responses from the Biden administration. Until then, the market dynamics are prices on oil, prices on wheat are going to still be pushing up because Russia is still going to be out of the market and Ukraine is going to be out of the wheat market. So, what are the investment implications? All right, we talked about how risk premium in stocks would go up, but that might be somewhat netted against the fact that there's a more cautionary Fed. I think that's still probably the right thing. A 10% pullback in the S&P is what we had expected for this year. And I think that, it's probably I think I wouldn't go all in with all these uncertainties, but I think if you have cash, this probably isn't a bad time to start thinking about getting some of it back to work, because we've had the kind of pullback that we thought we would have this year if you read our 2022 outlook. All right, what about energy? That's got to be a real thought with what's happening in oil markets. All right, so if you think about the energy markets, big oil, the whole oil industry has this huge headwind called Elon Musk. And not just Elon Musk, but what Elon Musk did with Tesla was convinced a whole lot of consumers that you don't buy an electric car because you want to save the planet. You buy an electric car because it's a better ownership experience. It's faster, it handles better, and because an electric motor is so doggone simple, a third grader can make one, and I did in third grade, it doesn't break down much. All right, so as battery technology enhances and improves, you've got Ford Motor Company spinning out its electric car division because they think it's going to be its own company. General Motors committing to by 2035, 100% electric. BMW, all the car companies all around the world are making a massive shift to electrification. And that means there's going to be lower demand for refined petroleum products like gasoline and the oil that you have to make sure you keep in your car every 3,000 miles. Right? That's the headwind that we've talked about many times in the past. The new tailwind that rolled with the tanks into Ukraine is Russia is an unreliable energy provider to Europe. Duh. And yet they're the dominant energy provider. Even Germany is now saying, we are going to wean ourselves off of Russian energy. Who's going to supply that energy? You go to Saudi Arabia, it's out of the frying pan and into the fire. They want to buy that energy from the United States. It is an awesome, extraordinary opportunity. Short term, granted, once you take over Russia's market share, growth isn't going to be there long term. But oh my gosh, it's 500 million people in Europe, and you can become the dominant provider of energy there. So it's pretty cool. Now, how is that reflected in energy price, stock prices? Well, the big integrateds, the ones you've heard of, the Exxons, the Chevrons, and so forth, they're either at or through all-time highs. So they're at the prices. If you go back to 2014 when oil was at $110 a barrel, you look at Exxon, it's pretty close to that same price. You look at Chevron, it's higher than that price. So a lot of this is baked in, but, good dividend, you now have secure cash flow, probably not a bad place for your money. If you want to be more aggressive, then E&P, exploration and production stocks, the really aggressive stuff, that they're the ones that are at the cutting edge of the fracking and finding new oil reserves and so forth. They're still down 40–50% from the last time oil was this high. And there's another type called MLPs. They own the pipelines and the storage facilities and so forth for the oil industry. They pay a huge dividend, which is kind of nice in a low income environment. They're still down 30–40% from when the last time oil was this high. So those are probably things that have a bit of a margin for safety, especially in light of the potential opportunity to replace Russia as the dominant supplier for European energy. Bonds are about where they were at the beginning of the year. They fell dramatically as it became clear that the Fed was going to be that rates went up for the first part of the year as people worried about a more aggressive Fed. Once those tanks rolled, bonds came back down. They're now about unchanged. Frankly, I think the die is cast that inflation is going to be higher for longer. So whether the Fed gets more aggressive or not, a 1.8% yield on a government bond, a 2.83% yield on a corporate bond, that's not going to look very good relative to the cost of living, and I'm not that interested. Gold is up about 7% and continues, I think, to be a good place, particularly as the Fed gets more cautious. I think gold continues to have a nice trend. And, commodities themselves, I get a lot of questions about, should we be buying oil right now? And the reality is that the problem with buying oil or any of these direct commodities is that you need oil to go from 108 to 116 to 126 and so forth to keep making money. By contrast, if you buy Exxon, Chevron, the integrateds, you buy E&P, you buy MLPs, they're gonna make a boatload of money if oil just stays at 108. And oil can even fall back to 80 and they're still gonna be okay. So, you know, from my perspective, I think the time to play the commodities was back, you know, that time has passed, and I think they probably have more risk than they have potential upside. And it's better to play the companies that benefit from a continued elevated price level for the commodity space. Thank you for joining us for Market Insights. We hope you found it informative. If you did, I hope you can like the video and share it with your friends. If you'd like to see more of our research, you can find it on caravelconcepts.com. Thank you.